Mm-hmm. 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 Let's go. I wake up to a little bit of drool on my pillow, feel like it's gonna be a bad day. Yeah, I'm tired of shit, and the coffee ain't hit yet, damn, ain't that great. I don't wanna go to work, cause my boss is a jerk, and I'm not even that paid. I need a change in my life, cause I don't feel alive, and there's nothing that makes me happy. Hold my beer for a minute, I'm about to quit my job, cash in for
Let's dive in. Our focus today is really on volatility, extreme global volatility. We're looking at a period that, well, it included the worst single-day stock market point drop since that April sell-off, also the largest cryptocurrency liquidation ever recorded, and geopolitics really seem to be taking center stage, driving a lot of fear.
Absolutely. When you dig into the source material, it's clear the whole financial system felt shaky. So our mission here is to try and cut through that noise. We want to distill the core mechanics of what caused this shock. We need to explain those three big factors behind the recent sell-off. You've got the geopolitical tensions, extreme market valuations, and then the dangerous role of leverage. And ultimately, the goal is to pull out that long-term investment philosophy, the one that helps you navigate these huge shifts without, getting completely sideswiped by the drama.
And the scale here is significant, isn't it? The sources don't just talk about the immediate turmoil. They even mention this potential massive $37 trillion financial reset. You can really sense the fragility. And that U.S.-China trade relationship, it feels like the global tripwire right now.
It really does. The initial shock was, well, instantaneous. You had the record stock market point drop. And at the same time, the biggest one-day crypto liquidation in history. And the sources keep pointing back again and again, connecting this synchronized volatility to one main factor: China, and how quickly things escalated there.
Right, let's start there then, because this isn't just a minor trade, Scott, is it? Our sources seem to frame it as a really fundamental structural risk that's been building up for, well, decades. What's the actual root issue driving this conflict, according to the material?
If you boil it down, it's that huge trade imbalance, fundamentally. The U.S. consistently buys far, far more from China than China buys from the U.S. Goods, services, everything. And this creates this enormous trade deficit. Critics argue, and the sources reflect this, that it poses a serious long-term threat to American manufacturing, economic independence, maybe even national security. That imbalance is really the bedrock of the conflict.
And that imbalance, that structural issue, that's what led President Trump to initiate the tariff escalation cycle, right? He brought in global tariffs trying to reshore supply chains. China hit back immediately with retaliatory tariffs. Then the U.S. announced even higher tariffs, and that directly contributed to one of the sharpest market drops we'd seen in quite some time.
Exactly. The market sort of stabilized after that, but those underlying tensions, they never really went away, and they just flared up dramatically on Thursday, October 9th. That was the rare earth mineral shock.
The REMs, rare earth minerals. China announcing export controls on these things. Can you explain why that specific move was such a potent escalation? Why did it hit so hard?
It's the sheer dependency. That's the critical detail. Over 90%, 90, of the world's rare earth minerals are processed in China. These elements, they're non-negotiable. They're essential for everything from your smartphone to, advanced fighter jets. Plus, the sources really emphasize their dual-use nature. They're critical for both civilian tech and sophisticated military applications.
Okay, so massive leverage there for China.
Huge leverage. China's official ministry line was that this was just routine policy, but the analysis across the board is pretty uniform. This was seen as a calculated strategic chess move, designed specifically to apply maximum pressure, weaken the U.S. position after those earlier tariff rounds. It's basically economic warfare disguised as bureaucratic procedure.
Which then prompted the U.S. countermove. Friday, the Trump administration fires back, announces an additional 100% tariff, plus new export controls on critical software effective November 1st.
And this is where the speed of modern volatility just becomes, well, almost absurd. The sources highlight how market instability perfectly mirrors political statements almost in real time. There was this analysis mentioned referencing the Kubesi letter tweet. Now, the letter itself is complex, but the takeaway was the pattern. Cryptic or aggressive posts about tariffs often appear late in the week near the market close. This injects uncertainty, causes market dips, and potentially allows certain players to buy assets cheaper before a quick, often informal de-escalation or solution is announced over the weekend.
Right, so the market gets whipsawed based on essentially a political mood swing or a strategic tweet. We see the market tank on a Friday announcement, And then suddenly over the weekend, one side or the other might soften the rhetoric, walk back the thread a bit, and boom, the market potentially recovers sharply on Monday. The influence a few political figures can have on trillions in value just through statements, it's really quite something.
It really is, and it raises a key question. Why did the market react so violently this time? I mean, this geopolitical tension wasn't exactly new. It had been simmering for months. The answer seems to be that the patient, so to speak, was already weak. The market had pre-existing conditions.
Okay, let's talk about those pre-existing conditions then, because leading up to this drop, we had seen one of the strongest 6-month market rallies, well, ever. And when gains come that fast, that hard, it naturally makes investors pretty nervous about sustainability, doesn't it? It felt like a nervous rally, maybe running on fumes or momentum.
Exactly. And that nervousness, it turns out, was pretty well justified. There were several clear bubble indicators highlighted in the source materials. For instance, search volume for AI bubble had recently spiked to record highs. You had prominent figures like billionaire investor Paul Tudor Jones publicly drawing parallels. He compared the market environment to the period right before the 2001 dot-com crash. That got a lot of attention.
And for a more objective measure, you mentioned the Buffett indicator.
Right, the Buffett indicator. Total market cap versus U.S. GDP. That metric had just recently hit its highest level ever recorded. Historically, that strongly suggests we were looking at one of the most expensive stock markets, well, ever.
Wow. So historically expensive. What about the structure of the market itself?
That's the other critical piece, concentration risk. Technology stocks now make up a larger chunk of the S&P 500 than they did even at the absolute peak of the 2001 tech bubble. And it's even more concentrated than that suggests. The top 10 largest companies now account for over 40% of the entire index value. So if just those few giants stumble, the whole index is structurally set up for a significant fall.
Okay, so we had this fragile backdrop. Highly concentrated, historically overvalued. The anecdotal evidence seems to back this up too, right? Investors were getting cautious.
Yes, the sources indicate investors were already, things felt stretched. They were pulling back, building up dry powder, basically holding more cash, ready to deploy. It suggests the market was kind of operating on borrowed time, just, waiting for a trigger, waiting for a reason to start selling off. The China news, the REMS announcement, that was simply the match that lit the fuse.
And the explosion was particularly violent in one area.
Absolutely. Nothing illustrates the sheer mechanical violence of that sell-off, quite like what happened in the crypto market.
Right. Tell us about that extreme drop. How fast did that cascade happen?
I mean, it was brutal. We saw the single largest one-day liquidation event in cryptocurrency history, and it happened in less than 30 minutes. Bitcoin printed its first ever $20,000 red candle on the charts. Just instantaneously, vast amounts of borrowed money, leveraged capital were completely wiped out.
Okay, we need to focus on that word, leverage. For listeners who might not be deep in crypto trading, can you explain why leverage, especially the kind of crazy 100x leverage some platforms offer, why that creates such a devastating chain reaction when the market turns down?
Sure. The danger is really the incredibly thin margin for error. If you're leveraged 100 to 1, you're putting down just $1 of your own money to control $100 worth of an asset. Now, obviously, if the price goes up, your profits are magnified enormously, but the risk on the downside is equally magnified. A price drop of just 1% means your initial $1 is gone, wiped out. And at that point, the platform automatically, forcibly sells your position to cover the $99 you effectively borrowed. That's a liquidation.
And that forced selling triggers more selling.
Exactly. That's the liquidation cascade. The initial price dip triggers the first wave of liquidation's forced selling. That forced selling pushes prices down even further, faster, which then triggers the next level of leveraged positions to hit their liquidation point. So you get this chain reaction speeding up as it goes, just decimating millions of accounts in minutes.
Yeah.
It's purely mechanical and incredibly destructive.
Just brutal. Yet, despite that sheer violence, the sources do offer a bit of perspective, right? Where did things stand after the dust settled?
That's a really important point. For all the drama and the record-breaking numbers, after it all shook out, both Bitcoin and the broader stock market had, pretty remarkably, only given back about a month's worth of gains. Which really brings us to the core challenge for investors, doesn't it? How do you take all this market drama, all this noise, and turn it into actionable long-term wisdom?
Yeah, that's the key pivot. How do we overcome the inevitable pessimism that these events create? Because there's always a reason not to invest, isn't there?
Always. Fear is a powerful motivator.
I mean, I can think back personally. Back in 2011, buying real estate, Everyone, the conventional wisdom, said it was a terrible idea. Bubble aftermath, don't touch it. Those properties are worth, what, 4 times more now? Same in 2017, people warning the S&P 500 was way too high, due for a crash. That investment's up massively, too. The fear narrative is just always present.
It is, and that's why we really have to internalize what the sources call the boring truth. Investing done right should be boring. If it feels exciting, like a game, like gambling, you're probably doing it wrong. Overconfidence, the emotional desire to time the market or beat the average, that's what typically destroys portfolios over the long run.
So simplicity wins out.
Overwhelmingly. The most crucial takeaway, backed up by decades and decades of market data, is this. The best, most consistently successful investors, they simply buy a broad, diversified index fund, like an S&P 500 tracker, and they just hold it for 20 years or longer. That's the secret, but it's not exciting, so people constantly try to complicate it. They introduce unnecessary risks, trying to be clever, and decades later, they often regret it deeply.
You also have to be mentally prepared for the downturns.
Yeah.
Right? The sources mentioned the bottom is often worse than expected.
Exactly. You have to prepare psychologically for the fact that the actual market bottom, when it comes, will probably feel much worse than you anticipate. It almost always happens at the point the sources call absolute investor capitulation. That's when pretty much everyone is convinced the financial system is broken, it's doomed, sell everything. That moment of maximum fear, maximum pessimism, that's usually the absolute best time to be buying, precisely because everyone else is desperately selling.
And the cost of trying to avoid that pain, trying to time the market, is huge. There was a statistic about missing the best days.
A critical data point, listen to this. Half, 50% of the S&P 500's strongest trading days over the last 20 years actually occurred during a bear market. Think about that. They happened while the market was generally falling. And if you miss just the top 10 best trading days over a 5-year stretch, your average annual return plummets from around 15% down to about 3.75%. Trying to dodge the volatility is incredibly expensive.
So we need to normalize these drops, put them in context.
Precisely. These recent drops, while sharp, are essentially white noise in the grand scheme of things. Since 1920, the S&P 500 averages 3 separate 5% drops every single year, 3 times a year on average. Since the 1940s, we've seen a 10% correction roughly every 20 months. These are not unusual events. They are normal, expected parts of the market cycle. And here's another fascinating statistic. Since 1926, the market has only delivered that average return of 8% to 12% in 5 individual years, 5 times in nearly a century. You're far more likely to experience a year with a huge gain or significant loss than you are to hit that smooth average return. Volatility is the norm, not the exception.
Okay, so wrapping this up, what does all this mean for you, the listener, trying to make sense of it all? It seems the core message is the market drama, the Trump tariffs, the China chess moves, the crypto meltdowns, all fascinating to follow and analyze. It really shouldn't impact your fundamental long-term investment philosophy one bit. Is that fair? Maintain conservative habits, stick to your plan, prioritize saving and frugality.
That's exactly it. Focus on the decades, not the daily or even hourly swings driven by a tweet or a headline. And while we strongly advocate for that conservative, boring, long-term investing approach, we do have to acknowledge the underlying systemic fragility that the sources point towards. For example, they mention this larger, perhaps more speculative possibility, the idea of a potential $37 trillion debt reset plan designed to slowly erase national debt, possibly involving gold and cryptocurrency as components. Now, we bring this up not as some kind of investment prediction, absolutely not, but because it underlines the core truth. Huge, unforeseen systemic shifts can happen. They are always possible. You need to structure your finances, your life really, to be robust enough to withstand pretty much anything that might occur, potentially with absolutely no warning.
Powerful final thought. Stay the course, trust the long-term data, and don't let the day-to-day noise derail your financial future.